We now have a keynote presentation by Elsa Ben-Hamou Besonville, ESG Consultants Lead for APAC from MSCI. Elsa will provide an introduction on what is sustainable finance and its role in helping economies move to net zero, as well as update on how ESG trends are impacting APAC and how sustainable finance is expected to develop in the region. During the presentation, please feel free to put any questions you have in the Q&A window, and we'll address these live at the end of the presentation if we have some time. I'll now like to invite Elsa to join us on screen. Over to you, Elsa.
Okay, I hope everyone can see my screen. If not, please drop a message. Thank you for the introduction, actually, Florence and IBF, for having us today as part of this conference on sustainable finance. It is great to be here and be able to share with you more on what we see happening in the sustainable finance and the ESG trends towards 2022, and how we can actually bring those closer to where we are sitting in APAC, and with a deep dive also into selected ones, which are even more relevant in the region for companies and investors. Looking at the lineup for the next 2 days, I'm very excited to hear actually from all practitioners, and I'm sure a lot of the themes I will talk about today will resonate and be discussed and challenged in more details. So now on the discussion for today and the story behind ESG trends. ESG has been here for a long time, and to put it in perspective, we have been at MSCI bringing out this ESG Trends Towards report for the last 10 years. And it's 10 years of ESG trends on what can shape society and impact investment portfolios and investors. When we first published our annual ESG Trends Towards a decade ago, climate change, the value of human and natural capital, and conflicting demands for water all made the list. And those also echoed in one form or another in each of the following annual forecasts that we published. So we're very proud that we've come a long way over the past 10 years, highlighting risk and opportunities for investors. And if we look back at those reports, there is definitely a thread that runs through them. And you can see how certain topics have transitioned to greater priority over others, and how they have impacted also sustainable finance as a whole. Well, looking at 1 year won't tell you what comes next. The act actually of considering annually what lies ahead really shows that if you have a long enough horizon, the ESG risks of today can actually end up changing the risk profile for investors tomorrow. So let's talk about this year now. And when we're thinking of what trends are applying to investor globally, but also in an APAC context, and the opportunities and challenges that it creates, we did actually combine them into 3 different buckets. One is looking at climate, and it has been at the front and center of a lot of dialogue. Again, looking at ESG as a topic and how that is becoming mainstream. And finally, looking at the risk and opportunities that are emerging and that have been evolving over the past couple of years. I think it's quite interesting from an investor standpoint to really look at those different trends and understand and identify the ones that relate the most to your investment ideas, your investment philosophy, as well as the one that can challenge the status quo that we can sometimes face. Without further ado, I'm going to do a quick whistle stop through few of those trends that you see here, and I will dive into them afterwards. If you want to look in more details in all of them, the paper is available on our website, but it will be also available in the skill zone. All the topics that I'm going to talk about have a global perspective, but are extremely important also for the APAC region, and I will provide you a little bit more detail on this specifically. So First, on the climate front, what we have is the new Amazon effect. And what we're essentially looking at here is the supply chain of companies. So we might be buying from Amazon, but then Amazon buys from someone else. And what we're trying to look at is actually that scope 3 emissions, which has been quite elusive so far. Most of the companies are happy to report on scope 1 and scope 2. So there are direct emissions, energy consumptions, but scope 3, that is the upstream and downstream effects, needs to be captured to have a full and holistic view. And the supply chain element is particularly relevant in APAC across the region on specific markets, most definitely, as well as specific sectors. Then, as part of the climate themes, we also have the private companies that are now under public scrutiny regarding their emissions. It's a key topic, really looking at the dichotomy that we see between public companies that are now pushed for mandatory disclosures, whereas private companies where a lot of inflows are going through don't seem to have that same pressure to be transparent. Then I'll talk about the coal conundrum. As you know, at the COP, there was a pledge to divest from coal. And there has been, sort of different timelines that were handed out and which country will actually commit to it. But the question looking at the investor side is really trying to rethink what this divestment is. Is divestment the only way going forward? Is that good enough, actually, to separate from coal? And what do we need to do? And this is, again, very relevant for the APAC region, and I will provide you more color on that. Taking a step back and looking at the APAC context overall of climate, what we have seen engaging and discussing with investors is that it is at the centers of investors' attention. Regulators, notably HKMA and MAS, have published various requirements for investors and corporates alike to disclose more on climate risk. We also see lots of organizations, banks, asset owners, asset managers, and insurance signing up to the net zero alliances and setting targets. So pushing towards the decarbonization of their businesses and assets. So leaving the climate aside for a moment and moving on to the mainstreaming of ESG topics, what we have here is firstly greenwashing, and a lot of you might be familiar with it and probably have opinions as well on this. And certainly what we are seeing is that it's going to be less of an issue, not more of an issue going forward. There is obviously a lot of noise around it at the moment, but we do find that there is a common language that is being used around this. We've then got the regulations at crossroads, and the question here has always been about, are those regulatory or mandatory requirements, both from corporates but also investors? Is there any convergence that we see, or is there any fragmentation happening for those requirements? And of course, when it comes to the regulatory topics across the globe, we see different paths, different pictures, and within APAC specifically, also some of those differences shows up. Finally, in the last buckets of the trends on ESG, we look at the emerging risk and opportunities. And here the question is on coffee versus burger. And what we look at is actually biodiversity, particularly when it comes to the agriculture and the food industry, seeing how change impacts the entire value chain of the industry. And the question here is about which one is more sustainable. Is it your coffee you're taking in the morning, or would that be the burger that you might be having at lunch? And of course, this is an evolving picture. So with that, I'm gonna jump in the first topic, and we are talking about private companies' emissions that are now under public scrutiny. So if you have actually look at this sheet, what it's telling you is that the largest private equity firms are disclosing data on carbon emissions. The first two columns are about referring to scope 1 and 2 measurements, and here all or most are green, meaning that they are disclosing. And we understand that many are choosing to disclose to the best of their ability. Where we see the main divergence are firstly on the scope 3 disclosure, as the majority is having partial disclosures, and it's represented on this sheet with the pink dots. And they are deciding to report on a selective number of categories, while some have absolutely no disclosure so far, and that's the red dots. And this becomes even more important when we look at the financed portfolio emissions. And that means within that portfolio, those companies that they have financed, there is a real discrepancy. You can see the red dots here. That means that they are not evaluating that part of companies within their portfolio. This picture might have changed since we published the report a couple of months ago, but why is that important is that investors are really looking at understanding the total portfolio footprinting of what they are investing in. And if we look at private equity notably, there is often an argument about the investment and the flows that have been put into private companies around the energy sector, and how much of that is actually being linked to fossil fuels. And what we have seen in the last 10 years, that is quite a lot of investment went in private channels onto energy space. And within that area, actually only 12% was on renewables investment. That being said, this is definitely a topic that has come to the fore now. And what we see is very much aligned with what happened for public companies that went through that before on mandatory reporting, while they would report partially but not totally beforehand. There is today an agreement around what the metrics are that could be mandatory or should become mandatory for private equity and private companies as the only way to get a complete transparency and accountability. And certainly for investors globally and in APAC, that will give them enough comfort to then choose to invest in certain companies or not. Then if we move on to the second point that I wanted to deep dive into, it looks at greenwashing. Again, here, this subject has had a lot of attention and discussion, and I think this is the core of what we look at. Inflows in ESG fund has increased. We've been reading on ESG very regularly in the press, so a lot of questions have arisen about the credibility. But if you think of ESG fund, they are as diverse as ESG investors. We often say there is no one size fits all when it comes to ESG investing. If you would ask 10 portfolio managers to define what a green investment is, you would get 10 different answers. A so-called climate fund could be one trying to engage big companies to decarbonize. It could be avoiding fossil fuel exposure or actively financing clean energy. But it can also be the three of those as well in one portfolio and strategy that likely meets some investor standards and objectives, but not some others. So there is a need to create some sort of common language and the alphabet soup that we have around ESG. And that seems to have emerged just in the last 2 to 3 years, that common vocabulary that will help improve transparency and clarify choices. It will then become harder to actually paint green sheen on funds and easier to verify the environmental claims that those funds have, providing more diverse and also credible routes to achieve ESG objectives. On this chart specifically, what we try to look at is the climate equity funds. And some, because they're distributed also in Europe, are classified as Article 8 and Article 9 as per the European SFDR disclosure. And we see on the left part of the graphs in the bar charts how aligned they are with a 1.5 or 2 degrees Celsius trajectory. And we see that Article 9 funds, actually 10.6% of those would be going into this trajectory of a Paris-aligned fund. What we also realized by using those classification on the right-hand side of the graph is that these funds were also more distributed towards the lower hand of the carbon intensity spectrum, so very low and low intensity, and less toward the higher hand relative to the entire fund universe, and also the uncategorized funds that might be exposed to climate. Why is that important? Institutional investor can rely on a lot of tools to assess funds, be it the PRI's transparency report, MSCI ESG fund ratings, but for individual investor, there are fewer tools available today. And regulations and labels are actually emerging in selected markets to really provide that transparency and verification of ESG and climate funds claims. And we see those standards solidifying at a rapid path. So yes, when we talk about greenwashing, I think there is a bit a talk about where we see that geographic differences. Where do we see the most amount of work being done? And obviously, Europe has been leading the charge on that with the EU Sustainable Finance Plan. But I would say that APAC is the next one in line. And we could highlight here, one of the latest communication from Singapore regulator MAS around the mandatory disclosure for ESG retail fund that will be coming up early next year. And this actually brings me to the next topic I wanted to talk about and share with you today, which is about regulations and how important those are in the markets that we are in and for APAC investor. So regulations being at a crossroad, it really depends also on the geography. Within APAC specifically, we see a huge divergence between like markets like Hong Kong and Singapore, or even Japan, and for that matter, Australia and New Zealand. So globally speaking, just in the last year, we've seen 34 regulatory bodies and standard setters across 12 different markets that have taken official consultation on ESG. And when we look at the different things that are being asked, both for companies and for investors, it can be daunting and confusing. So we analyze those regulations and try to see where the convergence are and where the fragmentation can play. And I think there are two folds. We see clear divergence on the ESG side, notably around the definition of materiality. And this is important for sustainable investment. Agencies in the US, Singapore, and Japan have focused on the disclosure specifically relevant to financial materiality, while in the EU, UK, and Hong Kong, they look at it on a broader societal impact and a wider spectrum, sometimes referred as double materiality. And such differences prove to be a persistent hurdle and obstacle for the convergence of ESG-related regulations. Having said that, we see a lot of promising development and convergence actually around climate. And when it comes to the climate data, climate metrics, most of what can be quantified and can be defined more clearly is available. And what is very different here as part of the different markets are the timing. We also see growing consensus for the common reference of scenarios for stress testing, notably those being advanced by the NGFS. While those trends that I've talked about have been identified as global, they are influencing investors and companies and are applicable in the APAC region. Though our team wanted to go one step further and looking more specifically at a regional universe of companies. And we have identified 3 of the 2022 ESG trends to watch, which particularly make sense and resonated in APAC. And I will touch upon each of those and how they can create different challenges as well as opportunities for companies in the region and investors. So the first key trend is about climate and the coal conundrum. So I'm going to repeat a few points that I shared beforehand with you. In an APAC context, climate is center for investors' attention at the moment from an investment strategies point of view, but also to an overall net zero strategy. And this translates into very unique set of challenges for investors in the region and notably on the coal conundrum. We talked about private equity and the exposure to the energy sector, but coal is transmitted through the entire economy and isn't just concentrated in the big emitting sectors like the utilities. And the key challenge in APAC on coal is how important it is to the energy mix. Today, it represents close to 50% of the energy supply, while it is 20% for the rest of the world. And as coal has higher emissions intensity, it means that the energy companies and utilities that rely on coal-fired power have significantly greater carbon emission than non-APAC peer groups. In addition, for the key coal-consuming markets that are India, Indonesia, and Australia, they end up showing a much greater climate change risk. What does this mean for investors? Those investors that are aiming for net zero portfolio, the easiest solution would be simply to divest from coal mining, energy, and thermal coal power plants in the region, could be reweighting towards less carbon intensive sectors or markets. In practice, this can be very complex for an investor to really escape coal in a diversified portfolio. So you can just exclude everything. And it's actually not necessarily a good solution from either a portfolio risk return as well as to achieve decarbonization in the economy overall. So as a result, in the region, many investors are focusing on the energy transition and how issuers in their portfolios are planning this transition. What can be done then? We looked at the universe of companies in APAC and had to identify like different tools that could be relevant for these investors. And they could be looking at how well companies are managing their risk on one side, but also looking at those transition opportunities. So you can think of an energy company with a robust transition plan already having low carbon exposure as part of their business model. Being a utilities company, transitioning their business model to selling down coal-fired operations and reinvesting into renewables, for example. It can also be companies that have set clear targets for their own net zero transition. And we see in the region a lot more companies actually reporting and taking a stand on those targets. Now moving on from climate change onto the second trend for the region is biodiversity. And biodiversity is even trickier. APAC has a whole multitude of biodiversity challenges because of the pressure on land. In the region, you have a half of the world's population, but only a fifth of the usable agricultural land. This puts the region under massive pressure on maintaining its biodiversity. Specifically on that topic, there is no standards metrics like we have for carbon emissions, and you don't have a full range of standards yet that can be coming quite handy actually for investors and companies. Although the TNFD, the Task Force on Nature-Related Financial Disclosure, are starting to come out, there is still a long way to go. And it means that today investors have to look at a lot of different elements and consider within their portfolio. So how we look at it today in terms of the risk side is evaluating how companies are managing their biodiversity and land use, but also looking at packaging materials and waste. And those have the greatest impact actually on the region, particularly for material sectors and the consumer staple sectors. And those companies within the sectors are actually owing the obvious concern on intensive land use. So you can think of deforestation in order to clear land for farming, and preservation of animal species and overall biodiversity. When analyzing the APAC universe, very few companies show best practices across the board. So for investors' purposes, an interesting aspect to look at is not only the companies that are facing the biodiversity risk, such as water use, toxic waste, or raw material use. It is also to look at the companies that are providing solutions, such as treatment solutions, water management, or regenerative agriculture. So you're wanting maybe to be more exposed to the answers to the problems than just minimizing the risk. Reflecting that with investors in the region and the discussion that we have had, a lot of them are talking about biodiversity, and based on their feedback, it seems that the topic is still very broad, and I think the upcoming recommendations on measurements will really help. And why I say that is because the topic is very broad, and investors sometimes have difficulty to understand what to focus on. Would that be deforestation? Would that be the loss of animal biodiversity, or water pollution, for example? And there is a clear challenge also on measurement capabilities. Last but not least, on the key trends that resonated within APAC region is the supply chain. And this is a well-known issue for investors. It's one of the longest running ESG issue that investors have been looking at in APAC. And traditionally, those were focusing on topics like labor management, whether there has been forced labor in the supply chain, and other topics like raw material sourcing. And these risks are indeed significant, but it has not affected a huge number of companies and has been focused actually on very specific sectors. But what is happening now, and reflecting also from the global trends I talked beforehand, is the concern about the carbon emission in the supply chain, the so-called Scope 3. And it means that companies where supply chain hasn't been previously considered as a risk are going to have to start thinking about the carbon emissions across their entire value chain. And this is where transparency, knowing what you're purchasing, who you're purchasing from, and what their climate profile is a bit of a game changer in terms of both sort of the transparency and the reporting. This means that, you might have originally thought of fairly safe sectors on climate change as part of a portfolio, but they have much greater risk than previously calculated. And a lot of investors are actually diving into that at the moment. When we look at the supply chain risk in APAC, we saw that the automobile sectors, the consumer durables, retailing, food products, and technology hardware are the sector that are the most impacted. And the main markets of concerns will be South Korea, mainland China, and Japan. In practice, for investors, they are looking today at more transparency. And this is a challenge for them today to really chase for that data. And they do so rightly because they want to be able to report on their carbon footprint overall. And some could argue actually that if you don't have your Scope 3 estimation, making any claims around net zero could be considered as greenwashing because you're not taking into account the full overall climate change risk, but only looking at a small portion being the Scope 1 and 2. So for an investor, you can, invest in key sectors and engage also with those companies in the textile and agriculture and technology that are highly exposed to supply chain risk. And you can also choose to de-emphasize the risk by reducing the exposure to the sectors. You can also select companies that are managing their supply chain risk quite well. And if we think of the auto manufacturers as an example and the energy companies, then we are realizing that a lot of them have taken responsibility of their Scope 3 emissions. And that's just not because it's being included in the overall carbon emission calculation and in their target of what investors are using, but it also affects how attractive their products are to the end consumer. So on that, this was the final one of the 3 trends that resonated the most in an APAC context, looking at listed companies, but also thinking of the investors in the region. Would you want to learn more? We've actually dived into a lot of metrics in the ESG Trendsetters in APAC paper that will be available in the skill zone. And then you can realize how diverse the metrics are and how investors today really are looking in the depths of the data and content to really minimize risk, but also take advantage of opportunities.